Now, all of the 6 members of the Monetary Policy 2 weeks ago had voted in favor of a status quo policy. But the minutes of the meeting revealed that inflation is back as an overarching concern, and one member even believes that a rate hike could be necessary. Ananth Narayan, the head financial markets at Standard Chartered Bank, joins us now to talk about that. Ananth, we were speaking about this during the RBI policy, about the possibility of a rate hike if the monsoons don't pan out as expected and inflation goes out of whack. Is that a fear that's now gaining more credence?
Morning, Sonia. Yes, I think it is. I guess the minutes clearly indicate that the MPC sees its mandate as primarily inflation focus, given the strong mandate it has from the government to do so. And the trajectory for inflation doesn't show inflation at 4% by the end of this fiscal year. In fact, it's going to be closer to 5%. Given that trajectory, clearly the MPC has taken it upon itself that it should do something to try and bring the trajectory into a more desirable route. So this bias towards higher rates and targeting inflation through higher rates will probably sustain and persist. And a lot of the factors that they mentioned, whether it's the Fed policy, whether it's the second order impact of HRA, of GST implementation, all of that, frankly, will remain for a while. We will see the Fed raising rates going forward. We will see uncertainty on monsoons. We will see uncertainty on GST implications for CPI. So to that extent, I think a rate hike seems a lot more likely now, given the clarity from the minutes, than a rate cut. Of course, our base case remains for a prolonged pause for some time, given the other situation. But the market is adjusting itself to the possibility of rate hikes rather than rate cuts or status quo.
Hi, Ananth. Methinks the tone of the monetary policy members was more hawkish than perhaps the data warranted. After all, oil has peaked off. Yes, we don't know about El Nino, though the IMD still says it's a normal monsoon. 6.95, I think, as we speak, or 9.7 did I see on the 10-year bond. What will you do at 6.97? You'll still sell, or is this at least buy level?
Look, at this point in time, I would still wait, Lata, for a couple of reasons. One is, I think it's sinking into the markets that we are going to see a bias towards higher rates from the MPC, given the nature of its mandate. Now, we can argue whether it's the right thing to do or not, but that's the nature of reality. To that extent, we have to be prepared for a hawkish tone prevailing for some time now. Secondly, as you said, uncertainty on many, many fronts will remain. And when there is uncertainty, it's always easier to be afraid about higher inflation than not. To that extent, that bias will probably remain. So, and the last thing I would mention is that there is also lack of clarity on how the supply-demand situation for bonds will pan out from here. While supply is under control, there is a question mark about how much of supply will come from state governments, given the fiscal pressures there. And plus, you must remember that unlike the previous few years, we will not have the RBI buying bonds as part of its OMO operations, given the liquidity situation. So that does have a bit of a question mark on supply demand. Given all of this, I think we could see a steepening of the curve. We could see longer term, the 10-year and beyond yields moving into a trajectory of 695, 715. So very difficult at this point in time to hasten up and start buying bonds. Having said that, for
are
international
CPs
investors,
and CDs also rising, Ananth, along with this in step? Because NBFCs were having it good, borrowing cheap from the market. Now all those who depend on wholesale funding are going to find money a little more expensive?
It has been happening since the policy, Lata. So you will remember that once the operative rate went up from 5.75 to 6% with the narrowing of the LAF corridor, all of the short-end rates started to move up as well. Plus now you have the MSS issuances going through in the past couple of weeks and for the next 2 weeks as the government mops up one-year money from permanent liquidity from the market. So that has moved the short-end rates up as well. So CP rates have gone beyond 7%, and the trajectory remains somewhat firm there. So overall, the yield curve has moved up. Of course, it also has an impact on a couple of other markets. So it is making the rupee a lot more attractive as well. From multiple perspectives, FIIs are seeing value in buying bonds at these levels, especially since global rates are looking soft.
Okay.
Secondly, from a FX perspective, higher short-term rates also means higher forward premia, which again is incentivizing exporters to hedge and getting them to come in, whereas importers are probably staying away. So in a sense, unhedged exposures are probably going up. But all these things are linked, as you know. I mean, it's the old impossible trinity all over again.
Thank you very much, Ananth Narayan, for placing both those